Arizona Personal Lines Insurance Exam. Welcome to the quiz. An insured has both a personal auto policy and a non-owner policy. The other insurance clause in both policies states they are excess over any other collectible insurance. In a loss, how would coverage apply? Is it A, the policies would pay on a pro rata basis? Or B, the personal auto policy would always be primary? C, the non-owner policy would always be primary? Or D, they would cancel each other out, leaving no coverage? The answer is D. When both policies contain excess other insurance clauses, neither wants to pay first, so they may conflict and in some cases result in no coverage or require court resolution, but typically excess clauses cancel each other out, leaving the insured potentially uncovered unless one is deemed primary by law or intent. Pro rata shares proportionally. Personal auto is not always primary. Non-owner is not always primary. Because mutual excess clauses can negate coverage, this is how they often apply. Next question. In life insurance, a term policy provides coverage for: is it A, the entire lifetime of the insured? Or B, a specified period of time only? C, as long as premiums are paid, with a cash value component? Or D, only if the insured dies by accident? The answer is B. A term life insurance policy provides death benefit protection for a limited specific period, such as 10, 20, or 30 years, or until a certain age. If the insured dies during the term, the benefit is paid. If the term expires without renewal or conversion, coverage ends. Whole life provides lifetime coverage with cash value. Permanent policies have cash value. Accidental death is a rider. Because term coverage is limited to a set period, this is its defining feature. Next question. A life insurance policy becomes matured when what event occurs? Is it A, the policy loan is paid off? Or B, the insured reaches age 100? C, the death benefit becomes payable, i.e., the insured dies. Or D, the cash value equals the face amount? The answer is C. A life insurance policy matures when the insured dies and the death benefit becomes payable to the beneficiary. This is the maturity event for most policies. Loan payoff is separate. Age 100 may trigger endowment in some old policies. Cash equaling face is not maturity. Because maturity occurs at death with payout, this is the event. Next question. What does the Safe Driver Insurance Plan, often called the Good Driver Discount, generally require? Is it A, the driver has been licensed for at least 20 years? Or B, the driver has not been at fault in an accident or convicted of a major violation for a specified period? C, the driver completes a defensive driving course every year? Or D, the driver is over the age of 25? The answer is B. The Safe Driver Plan or Good Driver Discount rewards drivers who have maintained a clean record by not being at fault in accidents and not having major traffic violations such as DUIs or reckless driving for a set period, usually 3 to 5 years, depending on the state or insurer. Long license duration alone does not qualify. Defensive driving courses may give separate discounts. Age over May 25th lower rates, but is not the safe driver requirement. Because the discount is based on a clean driving record for a period, this is the general criterion. Next question. An all-risk policy is another name for AN. Is it A, named perils policy? Or B, open perils policy? C, liability-only policy? Or D, guaranteed cost policy? The answer is B. All risk is synonymous with open perils or special form coverage, meaning the policy covers all causes of loss unless specifically excluded, providing broader protection. Named perils lists only covered causes. Liability only is separate. Guaranteed cost is pricing type. Because all risk means everything except exclusions, this matches open perils. Next question. In a homeowner's policy, what does ordinance or law coverage help pay for? Is it A, fines from the city for having an unkempt yard? Or B, the increased cost to rebuild to current building codes after a loss? C, legal fees if the insured is sued by a neighbor? Or D, the cost of removing debris after a covered loss? The answer is B. Ordinance or law coverage in a homeowner's policy pays for the additional costs required to rebuild or repair a damaged structure so that it complies with current building code zoning laws or ordinances that were not in effect when the home was originally built. Many older homes do not meet modern codes, and after a covered loss, such as fire, the insured must upgrade to current standards, which increases rebuilding expenses beyond kind and quality. Fines for yard maintenance are not related to insurance. Legal fees for neighbor lawsuits fall under liability coverage. Debris removal is usually a separate coverage or part of the basic claim. Because building code upgrades can significantly increase costs after a loss, ordinance or law coverage specifically addresses this extra expense. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.